The Fed would need some very strong data to encourage them to raise rates in September, which now looks highly unlikely. Andrew Kenningham, Capital Economics. Okay, well, the Eurozone's growth engine witnessed a rebound in investor confidence in August as Germany recovered following the initial shock of the UK's vote to leave the EU. Though how do you assess economic sentiment regarding the Eurozone at present?
Well, as you say, the ZEW survey rebounded in August. Both the economic expectations and current sentiment measures were up from July, which is, on the face of it, good news. But they remain at quite low levels by past standards. And also, we wouldn't put too much weight on this particular survey, which it captures the views of investors. We're more inclined to put weight on the PMIs, the Purchasing Managers' Indices, which were published earlier for July, and they show that growth remains relatively weak but stable in the Eurozone as a whole, and including in Germany. Overall, I think we have a sort of mixed picture of the Eurozone. Germany's doing much better than France or Italy. Spain is also doing well, and we think the economy is likely to grow by 1 to 1.5% over the course of the year.
Well, the Fed meeting minutes showed a divisive feeling between policymakers, as some made the case that the time is near to warrant a rate hike, whilst others believed more data is required. To what extent do you believe the time is right for the US central bank to act?
Well, the minutes themselves didn't tell us anything we didn't already know. We knew that there was a difference of view between the doves and the hawks in the FOMC, and it reflects the discussion which took place before the release of the second quarter GDP numbers and the employment numbers for July. And the GDP numbers were weaker than expected. The employment numbers were stronger than expected. So it's still likely that the FOMC will have split views about it. We'll be looking for signals from Janet Yellen, who's speaking at Jackson Hole next week. Our view is it's most likely now that the Fed waits until December before raising interest rates again. It would need some very strong data to encourage them to move in September, which now looks really highly unlikely.
Okay, and lastly for today, which other key indicators have you been scrutinising this trading week that have had a significant impact on the markets?
Yeah, so this morning we had retail sales data released for the UK for July, and those were very closely watched because they're some of the first numbers, sort of hard numbers rather than survey data, to come from the UK since the referendum result. The number was actually very strong, with retail sales up 1.4% on the month and nearly 6% year on year. So it does seem that UK consumers have not yet been affected by Brexit. They're still going out and spending money, which had already been indicated as a likely, according to the data from credit card providers. However, it's a bit early to judge that consumers are going to be fine over the medium term, because I think the negative effects from Brexit will come through only as inflation picks up as a result of the weakness of sterling. So, the jury's still out. Our view is that the consumption will weaken, but not dramatically. And this itself was quite a positive number.
Thank you, Andrew. Be sure to check back on Monday for our Week Ahead show. Have a good weekend and see you next time.